Imagine a roller coaster ride. That's the US stock market now. A 4-month-long rally, partly fueled by investors' expectations for interest rate cuts. But what happens next? The US stock market has been on a wild ride, with a 4-month-long rally that has in part been driven by investors' expectations for interest rate cuts in 2024 by the Federal Reserve. But this rally is set to face a test from two major events in the week ahead. First, we have Federal Reserve Chairman Jerome Powell's semi-annual testimony to Congress on Wednesday and Thursday. This will be an opportunity to hear straight from the horse's mouth about the state of the economy and what we might expect in terms of monetary policy in the months to come. On the heels of Powell's testimony, Friday brings the official jobs report for February. And here's where things get interesting. This report has the potential to move markets more than Powell's testimony, given what it could signal about inflation. If job gains come in above the 190,000 consensus expectation, it could indicate that inflation may continue to run hot. John Luke Tyner, a portfolio manager at Alabama-based Aptus Capital Advisors, put it this way: inflation has bottomed out but is still above the Fed's objective, and it seems like more labor market weakness is going to be needed. While we've been seeing headlines about technology-related layoffs, Tyner points out there's a resurgence of employment and wage growth in Middle America. The data from January seems to back this up, with 353,000 jobs created and a sharp 0.6% rise in average hourly earnings for all employees. As we look ahead to Powell's testimony and the jobs report, the stock market rally hangs in the balance. Will Powell's words and the jobs data support the investor expectations that have fueled the rally, or will they challenge these expectations, potentially triggering a market correction? As we wait for these events, the question looms: will the rally continue or hit a wall? Inflation, a word that can send shivers down any economist's spine. It has bottomed out, but is still above the Fed's objective. Let's take a step back and understand the context. The US stock market has been rallying, fueled in part by the anticipation of interest rate cuts by the Federal Reserve in 2024. But the specter of inflation looms large, and it could play a significant role in determining the direction of these rate decisions. Inflation, for those who need a refresher, is the rate at which the general level of prices for goods and services is rising. And as inflation increases, every dollar you have buys a smaller percentage of a good or service. It's a bit like being on a treadmill, where the speed keeps increasing and you have to run faster just to stay in the same place. Now, the data we have on inflation is a bit concerning. Consumer and producer price readings for January were above expectations, suggesting that inflation may keep running hot. The Fed's preferred inflation measure, known as the PCE, showed the monthly pace of underlying price gains rising at the fastest pace in almost a year. So, what does this mean for the stock market and the Fed's objectives? Well, the Federal Reserve has a dual mandate: to maximize employment and to keep prices stable. The current inflation scenario indicates that there may be more labor market weakness needed to bring inflation down to the Fed's objective. But it's not all gloom and doom. The recent data also showed a promising growth in personal income. Nevertheless, the inflation conundrum remains. Will the Fed stick to its planned rate cuts, or will the inflation data force a rethink? Remember, the decisions made by the Federal Reserve have far-reaching implications, not just for the US economy, but for global markets as well. It's a delicate balancing act, and one misstep can have significant consequences. Inflation is a tricky beast. Will the Fed manage to tame it? That is the million-dollar question. Jobs, 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 the lifeblood of any economy. How is the US doing on that front? Well, let's talk about the February jobs report. Investors and economists alike are waiting with bated breath for the numbers, as they could potentially impact the market significantly. If job gains come in above the 190,000 consensus expectation, it could signal that inflation may keep running hot. This is a scenario that has been keeping many a portfolio manager awake at night. But it's not all doom and gloom. In fact, far from it. Amidst the headlines about technology-related layoffs, there's been a resurgence of employment and wage growth in Middle America. Yes, you heard that right. Middle America is experiencing a job boom, and this is a trend that has been somewhat overlooked. January's non-farm payrolls data provides an interesting case study. It showed that 353,000 jobs were created, and there was a sharp 0.6% rise in average hourly earnings for all employees. This happened despite the highest interest rates in more than 2 decades. So, what does this mean for the economy? Well, job creation and wage growth are key indicators of economic health. When more people are employed and earning more, they have more money to spend. This in turn fuels economic growth. But there's an interesting twist to this tale. Even though job creation is strong, inflation is still above the Federal Reserve's objective. Some experts believe that more labor market weakness is going to be needed to bring inflation down. So what's the bottom line here? Well, the U.S. job market is showing signs of strength, particularly in Middle America. This is good news for the economy. However, inflation remains a concern. As the job market strengthens, so does the economy. But will it be enough to keep the stock market rally going? Only time will tell. The Federal Reserve, a key player in this economic saga. What's their next move? Let's delve into the Federal Reserve's potential actions and their impact on the stock market. At the helm of this decision-making process is Federal Reserve Chairman Jerome Powell. His semi-annual testimony to Congress is a pivotal moment that could either fuel or dampen the ongoing stock market rally. Investors are keeping a keen eye on the Fed's stance on interest rate cuts. Speculations are rife about potential rate cuts in 2024. These expectations have partly fueled the 4-month-long U.S. stock market rally. However, the magnitude and timing of these potential rate cuts could dramatically shift the market's trajectory. Powell is known for his cautious approach. He is expected to emphasize the need for greater confidence that inflation is falling towards the Fed's 2% objective before making any changes to the Fed funds rate target, currently set at a range of 5.25% to 5.5%. One misstep, one wrong signal, could send markets into a frenzy or cause rate expectations to go awry. Remember, Powell is not keen on making any sudden moves that could disrupt the market. He is seen as being reluctant to say anything that could cause a significant shift in the market or rate expectations. However, it's not all about playing it safe. As John-Luc Tyner, a portfolio manager at Aptus Capital Advisors, points out, the Fed needs to remain unified about the need to be patient and data-dependent. The current data suggests that rate cuts may not happen until later this year. So what's the bottom line? The Federal Reserve's decisions have a significant impact on the stock market and the economy at large. Their actions could either spur the rally or bring about a slowdown. As we await Powell's testimony and the potential rate cuts, we are reminded that the Fed's decisions are not just about numbers and percentages, but also about timing and strategy. The Fed's decisions are always a game changer. Will they spur the rally or bring about a slowdown? The stock market, a reflection of the economy's health. How has it responded to these events? The economic chess game has seen its fair share of strategic moves and counter-moves. The performance of the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite give us a window into the market's response. In the face of the anticipated interest rate cuts in 2024, we've seen a 4-month-long rally across all 3 major indexes. Now, that's something to talk about. Dow Jones Industrial Average and the S&P 500 have had their best start to a year since 2019. They've been basking in the glow of investor optimism, fueled by the potential for rate cuts. But what about inflation, that unwelcome guest at the economic dinner table? Well, the market did take notice. The January inflation data, showing consumer and producer price readings above expectations, made the market pause and reassess. The response? A slight cooling of the rate cut enthusiasm. Fed funds futures traders have scaled back their expectations for the number of quarter percentage point rate cuts by December. Still, the market has shown resilience. The S&P 500 rose by 1% and the Nasdaq Composite gained 1.7%. The Dow Jones, however, slipped a smidgen by 0.1%, a tiny blip on an otherwise upward trajectory. How about the jobs report? The robust job creation and wage growth data didn't seem to faze the market. It's almost as if the market was saying, "Inflation, we see you, but we're not afraid." The performance of the market shows that it is willing to dance to the tune of the Federal Reserve's decisions, but it's not a puppet on a string. It has its own rhythm, its own beat. The stock market is always full of surprises. The question is, what surprise does it have in store for us next? In the world of economics, nothing is certain, but with careful analysis and a watchful eye, we can make informed predictions. Stay tuned to this channel for more insightful discussions on the U.S. economy and stock market.